All right, so we're going to talk about a few things here that are pretty straightforward and simple, so I've combined them into one video. We're going to talk about gifts, inheritances, alimony, child support, and scholarships. All these things are things you're likely to encounter in your life, and so let's figure out what we got to do with them tax-wise. Okay, so as we mentioned, gifts and inheritances are generally tax-free. A gift must truly be a gift and not disguised as payment for services. I think I've mentioned in chapter 1, pastors are notorious for forgetting this. With the love offerings they get at Christmas time, those are really tax payments for services and not a gift, truly a gift. One of the things I've seen on the internet lately is people who suggest you leave a card with your tip at a restaurant and tell people that the tip is not a tip, it's a gift. Well, that's not going to fly because that's really a payment for services disguised as a gift. And so that's not going to work out. So if you're waiting tables and you're getting these little things that say this is a gift, not a tip, well, be advised, you're going to have to pay income tax on that quote unquote gift because it is not truly a gift. Inheritances are tax-free because the estate pays any taxes that are due on it. And so this works in a kind of an interesting way. And the IRS has really planned for you not to be able to get away from the estate tax if you try to give away your estate. And so that's why we look at two things here. Gifts of under $15,000 do not need to be reported. And that's per person to any other person. And so you can give away $15,000 to 1,000 people each, and you're not going to have to report any of it. But as soon as you give $15,001 away to any one person, you have to report it. You're not going to have to pay tax on it. The gift tax return is really just a reporting form that allows the IRS to adjust this number here. And so let's look at an example. Let's say you have an estate worth $12 million. So you know you're going to have an estate tax because you have 12 million and the exemption is only 11.4. And this number goes up a little bit every year. I think this is probably 2018's number, but it goes up every year. But quite frankly, I don't really worry about it because I'm nowhere near that number anymore. So don't have to worry about it. It used to be as low as $150,000, and that's where the estate tax problems were huge. But now with it being $11 million, most of us don't have to worry about it. I hope one day you have to worry about it. But for now, let's look at it 11.4. So you've got $12 million. You want to get below the $11.4 million so you don't have an estate tax problem. So you decide to call up your old buddy Joe and give him $600,000. Well, since it's above $15,000, you're going to have to report it to the IRS. And when the IRS sees that it's above $15,000, they adjust this number for you and you alone. So they subtract it. So you gave away $600,000. So now this number is going to drop to 10.8. All they do is subtract it. $600,000 minus from 11.4 is 10.8. So now you have an estate valued at 11.4, but anything over 10.8 is going to be taxable, which would be $600,000, which would have been what you'd have had to pay tax on if you wouldn't have given your good buddy Joe $600,000. So if y'all are ever thinking about giving me $600,000, don't let this stop you. Go ahead and do it. I endorse that. But just keep in mind that this is how they catch you doing that stuff. You can't give away your estate to avoid the estate tax because they will keep dropping this until it hits zero. So one of the ways around that is to plan your gifts in $15,000 increments. And this can go for you and your spouse. It's any one person to any other person. So you can give away $15,000 to me, and then your spouse could give $15,000 to me. So now you've given me $30,000 in 1 year, and then you can do it again the next year. The cap is per year. So December 31st, you and your spouse each give me $15,000 for a total of 30. January 1st, you and your spouse can each give me $15,000 for another total of 30. So now you've given me $60,000, but it occurred in 2 different years. And we're not going to have a problem with having to report it. So this is a financial planning strategy for people who are going to come up with an estate tax problem, is how to structure gifts and whatnot so they can slowly try and get down below that number. So long story short, you will never pay tax on a gift or an inheritance If there's any taxes due, it's going to be paid by the estate and not by you. All right, let's look at scholarships. I'm hoping you all got a lot of scholarships, so let's look at how we have to worry about them. They're tax-free as long as they're used for tuition. If you use it for something other than tuition, fees, books, and required items, so these are the magic items right here. This is tax-free, but once you use it for something other than these items here, such as room and board, you're going to have to pay tax on it. And so when you get that full ride scholarship, anything you spend on tuition, fees, books, and required items is tax-free. The part you spend on room and board is going to be taxable to you. Let's talk about alimony for a minute, because this got interesting as of December 31st, 2018. Now, we're going to talk about divorces and whether or not they were finalized in or before December 31st, 2018. So divorces finalized before December 31st, 2018 are treated differently than divorces post December 31st, 2018. And so pre-December 31st, any alimony that was paid was deductible by the payer and taxed as income by the receiver. And so this created a lot of headaches because, you know, anybody paying any money to an ex-spouse, they want to be able to deduct that payment. And anybody who's getting money from an ex-spouse, they don't want to have to pay taxes on it because they see that as their money oftentimes. And so what happened, the IRS did a study in 2010, and they found that in 2010, the deductions for alimony exceeded the income by $2.3 billion. And so that was costing the United States revenue of $345 million a year. And so with the TCJA Act, they did away with it for divorces that occurred after December 31st, 2018. So somebody who was divorced in 2016 and is still paying alimony today in 2020, they're still doing it with these rules. But people who got divorced after December 31st, so 2019 forward, they're going to do it under these rules. It's not deductible and it's not includable. And that makes it so simple. There were a lot of headaches before this because then I had to worry about the payor. Did he report all his payments to me so that I could deduct them for him? And then did the receiver, did he report all the payments that he received so I could include them in income? And of course, which way do you think it usually worked out? Of course, this guy, the one paying it, would make sure he gave me every penny paid. And this guy here would often forget and say, oh, I don't remember how much I got. So now that that's gone for divorces that happened 2019 and after, we don't even worry about it. When they start talking about alimony, I say, I don't care. It doesn't matter. It's not taxable. It's not deductible. Don't worry about it. And that kind of brings us to child support. Child support is the same way. Right here. It's not deductible, it's not includable. And this is another sticking point for people. I really don't like dealing with divorces because, you know, they're mad at each other and they don't want to talk to each other. And when I tell them they don't get to deduct their child support, even though they're giving that money to their ex-spouse for the care of their child, they get really mad about it a lot of times. Some people don't care. Not everybody's the same way like that, but so it's not deductible, not includable, just like alimony these days. And that's great. But look at some people who have some huge alimony. This guy was paying $900,000 a year. Now, he was divorced pre-2018, so he's still operating under these rules right here. So he's deducting nearly $1 million a year from his gross income. So if he had $10 million of income this year and paid the $1 million of alimony, now his gross income is only $9 million, and he's going to pay tax on that. And that would have saved him about $300,000. But now let's say he gets remarried to wife number 27 or whatever he's on, and then he gets divorced again, and he pays another $1 million in alimony to his newly ex-wife. He's not going to get to deduct it. So now, same scenario, he's making $10 million a year, but he paid $1 million to alimony. It doesn't change his adjusted gross income. It's still $10 million because he doesn't get to deduct it. And so he's going to have to pay tax on that money that he sent to his ex-wife, and that's going to cost him $300,000 a year. Now, this is an extreme example. Most alimony that I've seen has not been that crazy. It's usually, you know, under $20,000 a year. But even at $20,000 a year at 15% tax bracket, you know, that could have saved you $3,000 in taxes.